Hello, my name's David Kelly. I'm the Executive Director for the British Chamber of Commerce here in Singapore, and a very warm welcome to today's webinar, which is all about planning for a smooth and tax-efficient move to the UK. A huge thank you to our event partners, Select Investors, for sharing their insights and knowledge with us today, and for your continued support of the Chamber. It's hugely appreciated, so thanks to you and the team. For those considering an eventual or imminent return to the UK, it's important to understand the key considerations for a tax-efficient move, as well as the social implications of settling back after being away for a certain period of time. Martin Rimmer, Head of International Tax at Select Investors, will share the key considerations to ensure a tax-efficient move. And he will be joined by Nigel Preston, a Singapore resident from 2014 to 2018, who's been through this journey. And whilst he was CEO of St James's Place in Singapore, he's now the non-executive director of Select Investors, and he re-established himself as a UK citizen and has got his story to tell as well. There will be an opportunity for Q&A following the presentation, so please do post your questions to the dedicated Q&A box, and we'll address those towards the end of the presentation. So with that, and without further ado, Martin, a hugely warm welcome to you. Over to you. I'm really looking forward to your presentation, as always.
Thank you ever so much, David. It's terrific to be here once again. So let me start by sharing my screen and we can get cracking with this presentation, everybody. Indeed, thank you ever so much, British Chamber, for the wonderful work that you do. We are delighted to be associated with the Chamber, and you do such a wonderful job in so many ways. And thank you indeed to all of our listeners today as we listen on this very important subject. So, David, thank you. You've introduced. I will be talking through some of the main tax implications of returning to the UK, which we'll be doing in the form of a case study, which I think is a slightly more interactive way of going about things. I'll then be handing over to Nigel, who will tell his story, as David put it. Then we'll come back for Q&A, and I think that's going to be the format that we use today. So just before I get going, let me just say a few words about Select Investors. We set up in 2018. At that time, it was just myself and Miles Gooseman, who is the chap on your right, tallest guy at the end on the back row. And we rapidly expanded into a team of 18 professionals, and a number of financial advisors, tax advisors, and some terrific support staff. Everything we do for British people, we can also do for the Aussie community, and they're the guys and girls on the left side there. So there's an awful lot that we can offer. What do we actually do? Well, in essence, we very firmly believe that we can blend UK or Australian, in this case UK tax planning, with wealth planning and succession planning to help clients work towards a holistic, straightforward, intuitive and intelligent plan for their financial futures. We're actually very passionate about our subjects, but why do we do what we do? Well, we do it very simply because we want to get our clients to have happier, more productive lives in which they achieve their goals and ambitions from a place of constant financial security. And that's partly about returns on investments. It's partly about tax, keeping the tax liabilities down, and we'll be talking about that in some detail. But it's also about ensuring that our wealth passes in a controlled, safe manner to the next generation. That's really what we do and why we do it. Needless to say, we will be delighted to talk with you one-on-one. This is a case study we're going to be working through today and some of the key themes. And of course, your situation will be different. So obviously, on a no charge, no obligation basis, we're very happy to sit down with you and just explore your own situation. In follow-up, you will be getting the webinar link and obviously our contact details. So it's very much up to you then to reach out to us if you wish to do so. So inevitably, with all of these things, I need to provide a very brief disclaimer as we get going. So, as you might expect, we have to give you that. So everything you're about to hear is correct and accurate based on the law as it stands today, but it is general in nature. So please don't take any of this as a recommendation for personal action. In fact, the art in providing any kind of professional advice, whether that's tax, investment or succession, is about taking our extensive knowledge and applying it to you specifically. Now, you can go online and Google all of this stuff. The Revenue's website is actually very good when you get into it, and there's loads of stuff on the web. But what we want to do is take our experience. I think I must have moved to the UK 1,000 times over my career with clients, but really to apply that to you in a very straightforward, intuitive manner. So I would encourage you to engage with us individually, and obviously we'll work with you to develop those bespoke plans. So let's dive right in. First of all, the poll question. Let's just see what your situation is personally. So simple question is, when do you plan to move back to the UK? Is that going to be within the next 12 months, the next 3 years, some point in the future, or maybe you just don't know when you're going to be moving back? That will help us to sort of tailor what we say a little bit as we go on with the presentation. Okay. Yeah, within the next 12 months. That's very interesting. So a lot of this is going to be relevant to a good number of you. And then within the next 3 years, so basically, 70% of people here are going to be moving back within the next 3 years. So hopefully all of this will be very relevant to you. So let's dive right into the case study. Let's just move that on. There we go. So we thought a case study would be easier to, a little bit more relatable, to be honest with you. So I only have a small number of slides, but with key points and key observations to run through. So we're not talking about 30 slides in the presentation. I've got one on the main tax implications of returning to the UK. Secondly, the things that they ought to do ahead of relocation for tax planning purposes, what they should do upon arrival, and then I'm going to work through a number-based case study to show how actually the UK tax system can be tremendously tax efficient in certain circumstances. So look, case study, Matthew and Gemma, they've been here for 10 years, PR, got 2 kids, one at University of the UK, the other one doing A-levels here. Matthew is with JP Morgan, and Gemma runs her own successful consultancy business. She's doing very well with some local staff as well. Matthew is unfortunately made redundant and is offered a package, basically with the contract ceasing at the end of October this year, but he will be continuing to receive remuneration on schedule as if he hadn't been fired after relocation to the UK, and there will be a redundancy package. So a few key issues there. They want to get back early October and will go back into the home that they had rented out whilst they were away, and that was their main home previously. And they've decided at this point, you can see the assets there, they've done quite well for themselves, probably got enough to have a comfortable retirement, and that's what they decide to do. So what are the main tax implications with that? Well, I mean, to be honest with you, the UK tax code is so long and complicated that, it makes War and Peace look like it makes it positively breezy. If I was to stack up UK tax legislation as it's written down, it's about a foot high. So, there's a lot to it. So, as Albert Einstein once said, the hardest thing in the world to understand is income tax. But let's have a think about some of these main implications. The first and most important thing is how and when to trigger UK resident status. In their example, they're going back at the beginning of November, but the UK tax year starts on the 6th of April. And the default position, in fact, in the law for the year in which you become resident, actually you're resident for the whole year, which is nuts, because you've got this period from 6th of April, in this case, until early November, when the default position is liability to UK tax. However, it is possible to achieve what's known as split year treatment, a facility that allows us to split the UK tax year in which you go back into a non-resident bit and a resident bit. And that makes a lot of sense, but it does come with conditions. And it's very important that you understand what those conditions are ahead of time so that you can meet them. It would be a crying shame if, having gotten a long way through the tax year, you inadvertently fail to meet those conditions. So we need to guide you on what they are. And they're not difficult. They're not designed to catch you out. But like any game of football, you need to understand when you're offside. So do let us brief you on those. Secondly, employment earnings. Now, Matthew will be receiving the on-schedule vesting of long-term incentive plans. Now, you might assume that the earnings received whilst back in the UK would be taxable. Not so. They relate entirely to performance of duties whilst non-UK resident. So therefore, provided no continuing conditions, other than very obvious ones like not bringing the company into disrepute, as long as no other performance-based conditions exist, actually the payout of those long-term incentive plan awards tax-free in the UK. Now, that's not the case for share options. Share options have a different treatment. So you can see immediately that if you're going back to the UK, it's important to get advice where you will continue to receive earnings from employment that relate to your time in Singapore. But you know, the example, the case study is obviously a little bit contrived because I wanted to bring out loads of issues. And another very important issue is this redundancy payment that Matthew will be getting. Now, for the sake of argument, let's just assume that his entire career with JP Morgan was spent in Singapore. Were he UK resident when he receives that redundancy payment, 100% of that would be subject to UK income tax, and UK income tax rates are 20, 40 and 45%. So it is absolutely imperative that by hook or by crook, Matthew is non-UK resident when he receives that money. Now that may require them to leave Singapore, go on holiday somewhere, maybe Sandbox Phuket, and then get to the UK just to give some space for that money to be received. But if you're in a position where you're likely to get some kind of payout and they're tax-free in Singapore, it would be a terrible shame if you ended up paying UK income tax on it, because probably very little of those earnings would actually relate to duties performed in the UK. Property gains, in this case, they have a property. And you know, the fact that they've been away from that property does imply that there would be a charge to capital gains tax on at least part of that interim gain as relates to the time when it wasn't their main home. And we see this with many other clients as well. You know, clients are typically, you know, fans of property investment, as are we. We think property should be part of a well-balanced investment portfolio. But we need to understand what those gains are. If you used to live in the property as a main home, as Matthew and Gemma did, there are some tax reliefs that apply. But if you go back into it and sell it, you know, there can be quite a sizable charge to tax. So we want to map that, understand it, and that then at least helps you make decisions about whether or not to sell. We don't typically recommend sale ahead of relocation, but we do advocate you being in full possession of the latent exposures to tax that you're going to have to face with at some point. Fourthly, tax rates and allowances. When we go back to the UK, and you know, I'm going to be bringing this out in the case study in a moment. There are a number of features of the UK tax system that allow you to be, you know, allow us to take advantage of rates and allowances and various features that can help to drive our tax liabilities down. And that will be illustrated in a number-based case study towards the end. But suffice it to say that it is our preference that we want to use all of those tax rates and allowances, but we want to use them as far as possible with dividend income from shares and units and funds that you hold directly. The tax rate on that, the basic rate, is only 7.5%. Okay, that's going to go up in April to 8.75%. Thanks, Boris, for that. But also capital gains tax rates are also much lower than income tax rates. So having dividend producers in a retirement portfolio makes you know, a lot of sense. We also want to talk to them about the types of assets that they have. You know, people have investment portfolios as a consequence of good choices they've already made. So it doesn't mean that we have to completely restructure everything and throw what they've done before out to do something new. But we do need to understand the tax treatment of their assets. Some asset classes carry a punitive tax treatment in the UK. The majority carry a reasonably favourable treatment, but we just need to understand what they've got. And finally, you know, Gemma has a business. And you know, some choices are going to need to be made about that. She's running this successful company in Singapore. Becoming UK resident will potentially expose those business properties to UK corporation tax, currently at 19%, but from April 23 that will be 25%, certainly much more than here in Singapore. So does she intend to continue with that? Does she want to wind it down or sell it? If she sells it, will there be some kind of earn out period, some kind of payment of the proceeds from the sale of shares in installments? All of these things carry tax implications in the UK that we'd want to be advising Matthew and Gemma on ahead of time. So you know, there's probably latent gains in the business, and clearly we need to ensure that we're taking the right steps with that. So it isn't a given that everything just remains in Singapore. Everything will have a UK tax implication. Ahead of leaving the UK, what are the main things they need to do? They do need to think about, in this particular case, when to give up their PR status. If you go back to the UK and you give up PR status and you get your CPF paid out to you, then there is a charge to UK tax on that, but only on part of it, only on the employer contributions and the capital growth, or the interest added from 6th of April 2017. But that could be quite a meaningful amount. So we'd want to understand a little bit about CPF contribution history, CPF values, and there is perhaps some advantage to be gained by making sure that they're still non-resident when they receive those monies from CPF. Needless to say, there is a need to get Singapore advice, and there is a need to pay that dreaded exit tax as well. So whilst I focus on the UK side of things, we work very close with Singaporean tax partners. In fact, my second in command here was Christine, was until recently an expat tax advisor at Deloitte Singapore, so we can assist with that. Very important to make sure that you're up to date with your tax filings in the UK. That goes without saying. You want to go back with a clean record, all up to date, and don't listen if you sat here without that clean record. Talk to us, we can help you bring it up to date. I've done a lot of this work with clients in the past where we're all busy, aren't we, and it's difficult to file, and it's easy to get out of date with this stuff. But all we have to do is bring it up to date. There are no enduring black marks against your name, provided we do and say the right things in bringing you up to date, and we keep that going forward. It isn't a given that you will have to file a tax return when you go back to the UK. In Matthew and Gemma's case, they will, because they've got rental income, and they will, as we'll see in a moment, be having some taxable dividend income. But it isn't always necessary to file a tax return. Depends on your individual circumstances. So, obviously we'd want to be talking about that with you. And then when you're back, reporting for tax on global income and gains may require assistance of someone like me to help you get that right. They will need to give some thought, Matthew and Gemma, because they have decided to retire, about how exactly to fund that. Now, on the face of it, it seems quite simple, doesn't it? They've got some rental income, they've got some pension income, they've got an investment portfolio, they've got some money in the bank, long-term incentive plan things coming, and they've also got the CPF monies. But we want to try and do that in as tax-efficient manner as possible. I advocate having different buckets of assets. So property here, pension here, tax structured investment portfolio here, dividend producers here. And that means that we can have regular conversations about where to draw income from in a given quarter or a given year to ensure that we maintain optimal tax efficiency in retirement. All of that work needs to be done ahead of relocation to the UK. We would absolutely recommend setting up a dividend producing income strategy. As I mentioned before, we have the lowest income tax rates on dividends. Dividends are the only one that enjoys this currently 7.5% rate at the basic rate. As a tax planning principle, I don't want my clients paying higher rates of tax. The jump up from basic to higher rate for dividend income goes from 7.5% to 32.5%. For all other incomes, it goes from 20 to 40. I don't want my clients in that higher rate of tax, and I'm sure you would agree with that. Therefore, we have to ensure that the dividends we produce do not use all of your basic rates of tax. We need to leave some space for income growth, because if that strategy works and it's growing, the asset values are growing, more dividends are being produced, we need to leave some space for them to expand into without going into the higher rates. But dividend producing investments will only take you so far. So for the additional capital, we would recommend setting up what we in St James's Place lands call an international investment account. So the technical term is an offshore life assurance portfolio bond. In essence, you're allowed to take 5% of the amount invested as an income as a UK resident without having to pay tax on a year-on-year basis, either on that money that's drawn down or on the income and gains produced within the investment strategy. Now, that doesn't mean that there's never tax payable. There is. There comes a time when tax can be due, but the point is it doesn't come year after year after year, and it doesn't send you into higher rates of tax. So we do advocate that. And as I said before, decision needed about Gemma's business. In fact, there was one other thing I wanted to say there before leaving. It's also a terrific inflection point to think about inheritance tax planning, particularly in the context of retirement. You know, death and taxes, you know, may of course, you know, they're inevitable, but they don't need to be related. We don't want your death to be caused by tax, and we don't want tax to be a cause of death. Let's get this right ahead of relocation to the UK. In fact, the only difference between death and taxes is that death doesn't get worse with every budget. Very important to get IHT planning right. It's a 40% charge on taxable assets, but there is an enormous amount that we can do both here in Singapore and after you've relocated, but we do advocate doing it ahead of relocation, at least some of that planning, because if we're talking tax, we might as well nail that as well. And there are ways of getting tax efficient streams of income from structures which are acceptable to HMRC, very mainstream, but which are also outside of the reach of inheritance tax. So it's a great opportunity to kill various birds with one stone. So after arrival in the UK, we definitely would encourage them to invest money into individual savings accounts. You can pop in £20,000 per person per year, and the income and gains produced from that, you know, and you decide how that's invested, or we do if we're managing the money with you. The income and the gains generated are completely free of tax on a no strings attached basis. It's an unconditional exemption. Now, if you invest £20,000 a year for 20 years, if those stocks and shares deliver to you 3% dividends a year and you spend it, and an additional 2% in capital growth, after 20 years, you would have had over £190,000 of tax-free dividends, and you'd have an asset that is worth £500,000. So the compounding cumulative effect of this over many years is very, very compelling indeed. Now, it might very well be that that Matthew and Gemma decide to do some form of consulting work. It's very rare, in fact, to see people just lay tools down and not eventually pick them up in some capacity. Nigel is a perfect example of that. In fact, he thought he'd stop work permanently. Lo and behold, he's now working for us, and in fact, he's just about to be appointed as a managing director of Select Investors. Most people continue to do something on a very ad hoc way. So look, if that's you, if that's Matthew and Gemma, then we would want to think about whether it is best to be self-employed or to trade via a limited company. Simpler is better, but if the income levels rise, then there are advantages to having a limited company. And in fact, one of those advantages is tax-efficient pension funding. If you employ yourself through your company, the company can inject up to £40,000 of its reserves as a deductible expense within its accounts and as a tax-free benefit to you into a UK pension scheme. So, you know, if you continue to work, do think about continuing to contribute to pensions, because there are tax advantages there. You know, pensions, income and gains are not taxable. They grow free of tax. They're very, very cheap. Yes, you have to pay tax on what you draw, but 25% of that is tax-free. So it's definitely a place for pension. Otherwise, we have to think about how to draw money from existing pension schemes. Do we take a tax-free lump sum or not? Or do we decide to take 25% of every bit of income we draw tax-free out of a UK pension scheme? These are all decisions to be taken ideally ahead of time, ahead of relocation. That's called flexi access drawdown. You can actually choose what you draw and when in what we call defined contributions pension schemes. Needless to say, there will be a need in Matthew and Gemma's case to notify HM Revenue and Customs that they're back. And if they aren't already filing UK tax returns, they need to have notified HMRC that they will have to no later than 6 months after the end of the tax year in which they went back. In other words, going back this year. So they have to notify by the 5th of October 2022. And finally, if Gemma does decide to continue to run that business from the UK, it would need registration for UK corporation tax purposes. So there's a detailed piece of advice would be needed about the interaction of Singapore profits tax and UK corporation tax. So they're really the highlights in this very contrived example. What I then wanted to do is just go through a numbers-based case study to show you just how efficient the UK system could be. As I was preparing for this, I was reminded about this really very beautiful quote. It was given by a chap called Jean-Baptiste Colbert. I think he must have been a philosopher or a politician. It's a really wonderful quote that summarizes the challenge faced by all tax policymakers. So the art of taxation consists in so plucking the goose as to get the most feathers with the least amount of hissing, right? Isn't that wonderful? Just an absolutely brilliant analogy. Now, I'm going to show you now how we can keep all of those feathers on the goose, almost all of them, and so minimize the amount of hissing. The UK can be tremendously tax efficient. So I'm going to show you how. So first of all, we're going to be thinking about this generation of tax efficient income. Principle number one, use all of the tax allowances that you have. Now, if you add up your income tax allowance, your capital gains tax allowance, your dividend allowance, and your personal savings tax allowance, and if there are two of you, multiply that by 2, you could have up to £55,740 of money coming to you per tax year, completely free of tax, which is an astonishing number. Of course, you've got a plan that has to, it's a contrivance to plan that perfectly, but that's what we aim at. Use all those allowances year in, year out. And in so doing, we optimize who owns what, so as to ensure the full use of those allowances. As I've mentioned, taking dividends, joint ownership is often best just to maximize the use of allowance. We want to generate dividends as far as we can because the rate of tax is low. Dividend producing investment shares and units and funds can typically be sold to generate capital gains each year. So we want to make sure that we're taking enough capital gains to use those allowances as well. So that's embedded in that 55,740 figure above. We want to decide how and when to switch on pension incomes. In this case, Matthew and Gemma, they do have some pension income, they do have some property income, and then having made the investments into the international investment account, we then switch that on to generate the excess income that they need, but avoiding going into the higher rates of tax. So well, there we go, up to 5% of the amount invested can be drawn down tax-free annually. So in this example, Matthew has an occupational pension scheme of £8,000 a year, Gemma has one of £5,000 a year, and they've got taxable profit from rental investments of £18,000 a year. They have, if you sort of take their investment portfolio of 1.75 million, their CPF money and their money in the bank, probably about £2.5 million. So how can we use that and be tax efficient? They say their objective is to have £100,000 net of tax a year, but they also want to keep investment risk and volatility very low, like most people. So 4 to 5% return perhaps. So how would we go about doing that? Let me show you how. Before we do that, let me ask you a question. In this example, we will be generating gross incomes of £150,000. So the question is, what do you think the tax rate will be on £150,000 of income and gains in this example? Helen, if you can just share the poll question, please. Pretty please. Is that coming?
Martin, 2 seconds.
Yeah, no worries, Helen. No worries. No worries. If there's a problem though, Helen, I can just motor on.
Yeah, I'm just getting an error, so you might want to use the
yeah, just motor on. No problem. It becomes clear very, very quickly. So you know in your head what you would have chosen. Right. So let me show you how. Number one, Matthew and Gemma. Pension income, rental profits, so 8,000, 5,000, and the rental profits split between them. We would almost certainly want them to retain some kind of a cash buffer. I've done 110,000 here just to keep it numerically round, as you'll see in a moment. The return probably isn't 1%, okay? I'm being a little bit bullish there. But the first £1,000 each of income from deposits is tax-free. So in fact, it says bearing taxable income, and it is, but there's a special allowance that knocks some of that out. I've then gone £850,000 into an equity portfolio generating dividends of 5% a year. And I know that's probably a bit toppy too, but maybe not for Singapore, or maybe not for SGX, and UK companies are now starting to pay dividends. So just humour me on that. You can tell I'm not a financial advisor. So again, split equally. The first £2,000 of dividends each are tax-free. So we got up there to 74,600. Then we have some things that generate non-taxable income. So first year ISA allowances, and it's just first year. Next year they'll have double that amount, and they will continue to add 20 a year. But let's just assume a 3% dividend return which they take out and spend. That's tax-free. And then the balance of the capital into an international investment bond, investment account, generate from which they can draw up to 5% of the amount invested per policy year without paying tax. So that adds another 76,000. So total gross income produce of 150,800. So there's our 150,800. The tax liability on that is, would you believe it, just £4,000. They have to pay a little bit of tax on their pension, their rental and their interest, and they have to pay a little bit of tax on dividends, but it's only at 7.5%. After their dividend allowances. That does not amount to a lot of tax at all. And in fact, it's a marginal rate that's below 5%. So, and so far, all we've done is things that are extremely efficient and, well, not extremely efficient, they are efficient, but I mean, very well known, very accepted by the revenue. These are techniques that have been around for donkey's years. We just need to deploy them intelligently. So 146,000. We do want them to do their ISAs each year. So let's take 40,000 of that away to do ISA investments. And that obviously will increase dividend income in the following year. So doing that, their net spendable is 106,000. But we can take capital gains. So, you know, if we've got capital gains of, say, 2.5% on the equity portfolio per year, well, that can, if they wish to draw it, give them another 21,000, and that's within the level of their combined capital gains tax allowances. So if they wanted to optimise, you'd be looking at about 127,000, which is an effective rate of tax of 2.71%. You know, Noel Coward famously said, you know, I tried to pay my tax with a smile, but they wanted cash. But I think we would be able to smile whilst we pay a tax bill that has an effective rate of tax attached to it of just 2.71%. And the international investment account can be structured to be an inheritance tax efficient vehicle as well. So you can kill two birds with one stone. So, you know, if the mandate was to get £100,000 net of tax and fees, well, that's been amply achieved. And in that case, you know, 100,000, you know, as a function of 2.5 million gives us, you know, a risk tolerance of 4 to 5%. So very well achievable. So you know, summing all of this up, main tax principles, split year treatment, tax filings with the revenue, understanding the nature of your assets, considering inheritance tax, restructuring opportunities, looking at things that are bespoke to you, like your own latent property gains. When will you go back to the UK? Working towards a plan to deliver tax efficient income from inheritance tax exempt sources, all of which is eminently achievable. So with that, I think that draws my slides to a close, and I think it's now time to hand over to my my colleague and dear friend Nigel. Are you there, Nigel?
Good morning or good evening. Thank you, Martin.
Great to see you. I'll knock myself on mute now.
Great, thank you. Good evening, everybody, and welcome to my executive shed in Surrey, where some of you may have joined me previously. It's very damp and dreary here in the home counties. So the summer of last week was at least 3 days, and it's pretty much over. But we were able to get a bit of cricket in, but that was it. So in preparation for today, I'm mindful of repeating myself because I've done a number of these webinars previously with the Chambers and with Martin as our double act. And so in reflection of today, content, I thought what I would do, whilst I'll cover the slide as above, I will also try to talk to you a little bit about the here and the now, because I'm now 3.5, 4 years into the journey, having repatriated, and there's different challenges I and we face as a family now compared to maybe when I initially got back and was spending time talking to some of you about good housekeeping and where to get your Sky and broadband or whatever it might have been, which was all very exciting at the time, but less relevant now. So today what I'll try to do is give you an insight into initially why I left Singapore, a question I've been regularly asked, leading into the important part of today, which is the value of the good preparation. A little bit of here and now, what are the changes, what are the sort of things that are very different in our lives compared to when we initially got back from Singapore in 2018. And indeed, one of the important bits that I face, which even having been working for many years in a financial background, not in, thankfully for most of you, the advisory role, because that could have got very messy if I was let anywhere near investment performance. But in the managing director role or the chief executive role I had with St. James's, it was working with guys like Miles and Martin and other very, very capable, talented guys. But I used to listen to them an awful lot and thought, what are they actually going on about? Will that actually ever happen to me? And today I'll give you an insight into where some of that has actually happened to me. And there's some really important messaging. So the reason for our own decision to leave Singapore was that I suffered a health issue, which I think most of you are pretty aware of what happened. But I suffered a stroke one morning, fell off my, should we say, kitchen stool, was helped by my wife and helper into an ambulance. And thankfully, Singapore healthcare saved my life. But I was very lucky. However, that happened probably about 18 months quicker than we had planned. So it did present more than a few challenges for our own exit, which after careful consideration and St. James's Place asking me to stay on, I thought, there's a discretion being the better part of our time to step down and maybe think about taking a slightly more easier life. So we repatriated, but we repatriated at quite a speed. Okay, so it was quicker than we expected. And whilst the organisation were incredibly helpful with advisors and supporting us through that period of time, it still was very, very rapid. So the big thing that the 43% of you today that are planning to, so there must be about 25 of you on the call that are thinking of returning or planning now to return to the UK, you do have time to plan, okay? So I'm just going to do two bits of the plan piece to begin with, if I may, the value of good preparation. Then if you are in partnership and there's two of you beginning this journey, husband and wife or partners, whatever it might be, what worked for us is my wife organised the exit and I worked more around when I had my compass mentors about me with sort of life in the UK thereafter, as it were. So I had blue jobs like finance and bins, and she had obviously the more important things. So in our journey, that worked incredibly well. There were two people working on different parts, but we communicated regularly so we were on the same page. Because one thing I've got to realise in our journey is that it doesn't matter who your organisation, how well organised they might be, and in some cases, organisations aren't paying as much for repatriation as they might have 3-4 years ago. It can be a really, really helpful thing, but the minute you get back, it pretty much disappears and you've got a lot in front of you to get your head around. So two plans. One is your exit plan. And as Martin sort of, has put it, before leaving. And now I'm going to talk a little bit about, the after arrival, as it were. So the first thing that has happened to us, which is really relevant to me, everything has pretty much changed. I came back initially thinking, right, that's me retired. I'll spend a bit more time at Stamford Bridge, which is with my religion of Chelsea supporters that have, or travelling the world a little bit more and see some of the places we didn't quite get to, or indeed maybe try and do something about that dreadful golf handicap. Well, thanks to Martin and Miles pulling me out of retirement to semi-retirement into a non-executive role, that lasted all of 18 months. And that, for all intents and purposes, when we first got back to the UK, didn't actually seem like an option. It just wasn't, it was the last thing I was thinking about. And why I mention that is that when you look at financial planning and tax planning, the way in which we educate, and these guys are at university level now in terms of their knowledge of what they do, we make sure they don't just think about asset appreciation for clients, but we also look at preservation. Now, what's happened in the last 3 years, which even is a more predominant subject of discussion in the UK, and Martin does it extremely well, is utilisation. So you've got capital appreciation and you've got capital preservation. So that's like avoiding things like, estate planning and enjoying good estate planning and avoiding inheritance tax. But the big thing now is utilisation. It's like, how do you use the right pots of capital or income you take from ISAs or pensions in the right way, in the right time, as it were. And I've got to say now, that is not a do-it-yourself job. I thought I could do it myself. I really did. And you'd like to, some of you probably think, well, maybe you should be able to. It isn't that simple. I've had more meetings with my advisors, whether it be on, just recently face-to-face, but online in the last year, with what is a very, very simple, situation that is complicated purely because of the different tax challenges you face in the UK. It is literally, a half a day, a week job nowadays to make sure, as I've gone from working in that which is the sort of, the retirement pot completely to now earning a bit of income, it throws up a lot of complications. What happens with people that have had a relatively, and this is pretty much common, a relatively busy life, is that you like to think that you're going to sit back and, sort of maybe be a little bit more philosophical about life and, do things like yoga or meditate and so on and so forth. But we've been busy people and we keep busy people. It's in our nature. So a number of you that might be considering retirement, I'm sure you will, but you might only semi-retire. And that throws up a lot of questions in there about how you generate income, which is what Martin was referring to earlier. So my tip would be, one of the big tips, don't do it yourself. I don't think it is possible to do it on yourself. Even if you're the most accomplished of mathematical people, I don't think it's a job at all. Because more importantly, things change, even since, I've been working, on these sort of different journeys we would take financially, everything changes. So the other thing I just want to touch on now is the here and the now back in the UK. So life is pretty much back to normal. COVID really, we've seen the back of it. I'll be going to my church of choice this evening, SW6, Stamford Bridge, to watch my football team. And there will be 40,000 people there. And I'm sad to say not many of them will be wearing masks. And that's not a reflection of Chelsea fans, which some might say it is, but it's more a reflection of what life is. So we're pretty much back to normal. There are certain things that you will miss from Singapore. Definitely the esprit de corps, that friendship, that very, very close community that you have as an expat. But what I would say, there's a lot more to do in the UK. Only last week, I think I was at 4 different sporting events, from the racing to the cricket a couple of times, and indeed popping to see the football. And that's just sport. There's a lot more that you suddenly have exposure to. And funnily enough, I was trying to work out the 4 things I did last week. Actually had no more financial outlay than having a couple of pizzas with the family on a Sunday afternoon at Sento's with a bottle of Gavi de Gavi. So it's also a lot cheaper, I can assure you. So for me, one of the things that is really important now is to look at the collective 3-legged stool. There's the tax situation, which is very different. It is complicated. You will need advice. There's the pension situation, as we call it, the retirement arena, as it were. There is a huge retirement flexibility. There are some very, very clever things you can do with your pensions if you choose to do so. And then finally, the piece about income. And that's where you have to get the stool to work, which is having 3 very equally, equal legs, as it were. So for me, I think one of the most important things to just remind you about is in repatriation is that things are very different here. They aren't that complicated, but you will need advice. Our own life has changed. My wife's moved to electric cars. Our 2 daughters have left home. and we're empty nesters. So fortunately, the bank of dad is now shut, which is a relief. But amazingly, my 25-year-old daughter is getting to be a bit of an expert on legacy planning for some reason or another. But anyway, the life here is good. And for those of you that are repatriating in the next 12 months, if we can help you in any way, we have a repatriation process now in place, which is, I like to describe as helping you put each plank on that bridge as you make the journey back. And some of you know Alex, who's worked with us previously, and Alex is now our client liaison for repatriation. So if you are a client and you're beginning that journey, we'd be happy to help you on those early stages, as it were. I'm mindful of time, so I would just leave you and say thank you for listening to me and sort of indulge myself for the last 10 minutes. And over to David.
Oh, thank you so much indeed, Martin. Really, really great case study. Really enjoyed that. And Nigel, thanks so much for sharing your story as well. Thanks for the personal touch as well. I'm glad you're okay for obvious reasons. So now's the time for some Q&A. So please put your questions into the Q&A box at the bottom. Just before I do that, if I could ask you a question, both of you actually, just while the questions come in. You've talked a lot about sort of tax planning theory here, but Martin, from your perspective, how do you actually help your clients to turn that tax efficient theory into tax efficient reality, if you will? How do you make it actually work? And hopefully I can ask that same question to you both, actually.
Yeah, that's a good one. So much of my job is talking, and talking doesn't really get us very far. So we need to, obviously developing a plan, but actually, with a client's consent to actually then acting upon that plan. So look, if we recommend that certain structures need to be set up, is a client happy for us to do that? They don't need to use it, they can go somewhere else. The point is we develop the plan, but actions are then needed. One thing that we've become very passionate about over the years, though, is as people move from Singapore to the UK, the whole of their life is changing. What you don't want is your tax and financial planning to be another burden on top of that. So we're very keen, and Nigel will give his own answer to this in a moment, but where our clients are on a track towards repatriation, we're working with them nice and early. We're introducing them to the UK advisor that would look after them when they go back, so that person is a known quantity. We're building financial plans with that individual whilst in Singapore, so that nothing is a surprise. So there's if you like, a progression of agreed things that happen that the client doesn't need to worry about. We're trying to sort of take that thing off them so that they can go and enjoy their retirement, or moving is a stressful thing anyway. We're looking to connect our clients with like-minded repatriated people in the UK through engagement and getting people together, and really we're wanting to be there as well, very much to answer the kind of questions that Nigel's spoken into. There's a lot to think about. When we group our clients together to talk through repatriation here, they're all on the same journey. So there's a benefit in bringing people together to share thoughts, questions, experiences. So we're not individual silos. We really try and bring people together a little bit on this. So Nigel, anything to add on that, my friend?
Yes, I always refer back to some learning earnings I had in terms of the role of good wealth managers, and one of the key qualities of success, quite bluntly, was relationship building. And at a time when you're going through quite a significant thing in life, whether it's up there with marriage, home buying, or dare we say divorce, a move from a part of the world back to to the UK as well, is quite an emotional journey for a whole host of reasons. And to know that you've got people that know a little bit about what your things are, your values, etc., what you want from life, is incredibly incredibly helpful. And that experience can be challenging. What we now have the fortunate, I suppose, position to say, David, is when we started these conversations, there was me. I was the repatriated individual. There's now Alex, and there's now another guy called Danny, who represents us in the UK, that have all repatriated. So the word is empathy, Martin. We now have the empathy that at an early stage, if a client invites us, allows us to engage with them, you know, we can really help them on put those planks on that bridge, as it were, with a relationship that we'd like to hope, you know, can sort of, you know, build on for the future as well, and alert them to other things they need to achieve in a timely manner.
Thank you. No, that's brilliant. That's great. Really great to hear. I like that. I like the fact that grouping clients together because we're all going through the same journey. It's fabulous. Martin, we've got a question in the chat here actually, which is there a case for leaving some investments in Singapore once you go back to the UK? Are there opportunities for investments to stay here in country?
Yeah, I love that question. Thank you. I think it was Andrew who asked that, wasn't it? From a UK tax point of view, there's no reason to do so, particularly. Therefore, there's no reason not to. You're not going to be placing yourself into a worse position by choosing to keep, for example, SGS listed stock versus taking it and putting it into the FTSE. Your call. I would always say, chase the money. Do what's going to make you the most money. It's my job as a tax planner to create the tax plan that helps you to enjoy as much of that as possible. I'm quite fond of saying to clients that, you know, the best I can do for you is to keep 100% of what's yours in your pocket. But the investment choices that you make or your advisors make with you can create wealth. So chase the money. If you want to keep investments in Singapore for that reason, do it. Help us. Let us help you build a tax plan to take account of that.
Super, thank you. And if we can stay with you, there's a question here from Kate as well around, is Singapore exit tax only payable by PRs, by permanent residents?
If it were only payable by permanent residents, I'd be giving mine up before I left. Sadly, it applies to everybody. Employment pass holders, work pass holders, not Singaporeans, of course, because unless they relinquish their citizenship. But if you go and you remain PR, I don't think you have to pay. I'm not sure actually, but certainly it isn't something that's just for PRs and citizens. It also definitely applies to employment pass holders, I'm sorry to say.
Super. Another question that we've got here as well is, obviously this is quite a turbulent time for a lot of people, lots changing all over the world. Are there considerations for those looking to relocate back to the UK that might want to come back to Singapore at a certain period of time? How much thinking do we need to do around that piece?
That's a terrific one. If there was the if I could design a tax plan that would allow someone to be in the UK for a period and then leave again and do it optimally, I'd be saying don't spend any more than 3 years, 3 tax years in the UK. All right, that's the first thing I'd say. Second thing is, if you have formed the intention, this is a bit of an inheritance tax one. If you decided that Singapore is going to be your permanent home, but say job sends you back, then the fact that job sends you back creates us with all kinds of inheritance tax problems. But if we're then coming back again, it becomes much easier to extricate yourself from the inheritance tax system as well. Great question. And also, you definitely want one of these international investment accounts, actually, particularly if you're working. So let your money grow tax-free. You may or may not want to draw on it, but when you leave, then you're taking yourself out of the tax system, and it's an international account. It's not a UK account. So it carries the benefit of not remaining within the UK tax system just because you were there.
Superb. If I put a gun to both of your heads and said, what's the single best bit of advice you can give somebody, from your position here, Martin, when you're advising your clients, and Nigel, having been through this journey, what each of you would be that sort of one bit of advice that would be a takeaway for everybody? Nigel, if I can start with you.
I'd refer back to those plans, David. Have a plan for leaving and arriving, 2 different plans, but own them. Yeah. And so what I mean by that is, don't delegate it to a helper, in Singapore to do all the moving. Understand where everything is. And I can assure you, we found things years later we didn't know even exist. We thought we lost them, but no, I'm being facetious. I'm just saying, look, don't delegate it just to an organization. For example, with the tax situation, tax organization, which I won't mention for obvious reasons, but one of the big 4 had all their arrangements organized for me. And then when I arrived, there's no further advice. So you've got to be sure to own it properly yourself, to think, how does something look thereafter? Don't be completely reliant on advisors or services that won't be part of your journey in the future in the UK.
Superb. Thanks, Nigel. Same question to you, Martin, as well.
Thanks, David. There's so much I could say. Look, I'm not going to say seek professional advice, so I think that's really, really important. And I'm also not going to say invest your money in tax efficient structures, though that's very, very important too. I think if you were going to shoot me, and I had to say one thing, it would be understand split year treatment. Understand when you become resident. Without that, neither you nor we will know whether what we're doing is right, and we won't have a window of tax planning opportunity. So that, I would say, is the number one thing. If we get that right, all other benefits, the benefits of professional advice, the benefit of tax efficient restructuring, flow from understanding that. I've got a, if you permit me, David, I think it's a 4-pager write-up. It's a synopsis of the 100-page revenue manual on these rules. If anyone wants a copy, just get in touch, either to you or to me.
Superb. And I think Einstein could have done with those as well from your presentation too. That's really, really helpful. I think we've got time for a couple of questions. So there's a couple that have come through. So before you talk about fees and at what time people need to start talking to you, which is obviously a very, very important question. John's come in here with a question around, should we be concerned about the fees on an international investment account versus running your own investments through ETFs? Will those fees into your returns and growth, or do the tax advantages outweigh this?
Yeah, sure. So it's a terrific question, and thank you for that, John. It's one of those things that goes straight to the core of the matter. So I think I'd say a couple of things. First and foremost, it's your money. If you want to invest in ETFs, I mean, I'm not an investment advisor, but we all understand they're very low cost. And it's all about making as much money as possible and doing so as efficiently as possible. ETFs don't carry any inherent tax advantages, but as I said, it's the way you hold them that's important. So whether it's an international investment account provided by St. James's Place, or for example, an international executive account, I think they're called, provided by Quilter. Yeah, cost is also very, very important. All of the rates of return that are quoted at St. James's Place are after product fees and costs. Of course, cost is important. We want to be very sensitive about that. We want to build long-term relationships with our clients, and there therefore has to be, it's a commercial relationship. So obviously we need to be paid for the great work we do, but you can't always be worried about costs. You need to have a good deal, and you know, we're committed to delivering that. And where clients do invest with us, more often than not, we simply provide all the tax planning support at no additional cost to that. So I hope that answers the question a little bit, John. I think there's a second question there as well, was there?
Yeah, there is. Just about sort of how soon before returning to the UK do we need to start talking to you, Martin, basically, and how much do you charge? The classic question.
I love that. These are great questions. Super. So look, in an ideal world, I would have given you full and formal tax advice, and we'd have developed the plan by the end of the December in the calendar year before the tax year in which you move back to the UK. So if you're going back to the UK this year, I'd want to have given you ideally all the advice by the end of December last year, because it kind of leaves 3 months of that tax year to do any execution. That's not always possible though. So look, you know, I've had people come to me a matter of weeks before relocation. There's normally something useful that we can say. Now, what are our fees? So for tax advice, there's a couple of ways of approaching this. Number one, first and foremost, we want to provide you with a quote to give tax advice. Okay, so it's a fee-based, it's based on an hourly rate, and I'm very experienced in determining how long these things typically take. 8 to 10 hours to gather information, turn it into advice, build a plan, work with you, $4,000 or $5,000 plus GST. On the other hand, so we think it's very important to have that fee, because then you're not in any way obligated to do investment business with us. We don't want people to feel obligated in that way. But that said, if discussions do ensue with our financial planners and the decision is made to trust the management of assets to us, you know, we may simply work with you and decide not to raise that invoice just as a gesture of goodwill. Depends on quantums, of course. But first and foremost, we would provide you with a fee, so as not to engender any undue obligations.
Superb, thank you. I know we're right at the 5 o'clock mark, but I just thought it'd be really nice, given that it is such a emotive decision to leave a country that you're working in, if I could just end with Nigel and sort of just ask you the final question, which is, what do you miss, or what is different about the UK compared to Singapore? Having relocated back, are there things you miss from the country?
Of course there are. You know, it was a great life experience for me and my family, David. It was you know, a great way to well, at that time I thought I was standing down. A good testimonial year that's been changed. A bit like Ronaldo, I suppose, going back to Manchester United now, being dragged out of retirement, but had to get that in. What do I think we missed the bit that's been ever so hard for you guys, which is just to be able to jump on that plane on a Thursday evening and go somewhere that was just a completely different life experience, you know, wherever your favorite islands and experiences and destinations are. I missed having to put the bins out, so I can just drop them down the chute in Singapore, where I actually have to walk to the driveway. And when you come back to the UK, it's quite amazing, David, but you have to pack your own shopping, Waitrose, which those would be the ones that really throw me out. No, I think what my wife has personally missed. So let me do my wife has missed that esprit de corps. And it's quite amazing because over the last year, she now has her own social group of 6 to 7 of the wives that she, as I refer to them as the champagne hounds of Sentosa. They could sniff out any deal. They now get together in Covent Garden at the Ivy or whatever once a month, and they're all over here. So she loves that, because those people that have that like-minded experience, that really sort of yes can do attitude. So we miss that. I think at times you return here, you know, and people don't have quite that yes can do attitude, getting up and wanting to do things. And there's lots more to do here, but people just, for example, just don't seem, there's a bit more suitability, I would say.
It's a really good point you raised, actually, Nigel. I know we're out of time, but I sense with some clients that returning to the UK can be quite a lonely experience as well. You're going back to a place where people don't share your experiences. So one of the things we're really, really committed to doing, and we're doing it now, is connecting our clients who have returned. You know, putting like-minded people with similar experiences in a room, even if it's only once a quarter. And for those who are on that track in Singapore, connecting them so that when they are all back, if friendships have been struck up, they can be continued. So yeah, really great.
Yeah, I think what happened initially, Martin, we believed there would be some people. Now we know there's a lot of our clients that are now repatriating. So just in the same way, David, you know of our modus operandi, Alex is now capturing those people, and we will have social stroke sort of communication update meetings in the UK. We will have a defined repatriation service to be able to share with people by the end of this year, hopefully in December. So anybody that's on the journey, all I could say, quickly engage through the various channels if you'd like to know more about that.
Superb. Thank you so much indeed, Martin. A fabulous presentation, really digestible as well. I think that's been really helpful for everybody on the call. And as Martin mentioned in his presentation, this will be available for you to relook at as well afterwards. And Nigel, thanks for humanising some of that as well, having gone through the journey. Really important to hear, you know, the emotive part of all of the practical advice we've heard as well, because it is a massive life step. So a really great session today. Thank you both so much. That's been really good. And thanks again to Select Investors for continuing to support all of the key themes that the Chamber's working on to support our members, and particularly with the UK Outlook series. It's really important. We are really pleased to have you on board. So thank you so much.
My pleasure.
Thank you. Just before everybody goes, just to highlight a couple of the Chamber's fantastic webinars that are coming up. In particular, we've got our 22nd annual Business Awards ceremony on the 4th of October. It's the longest standing international Chamber Awards programme here in Singapore, and we've got some fabulous entries this year, some brilliant finalists, so please do support the very best of business then. We've also just gone live with a new member dialogue with Dr. Tan See Leng, the Minister for Manpower, on the 15th of October. So lots of conversations around the employment piece here in Singapore. So it gives you an opportunity to really delve down in some of the key things there as well. So please do look out for that. Of course, you'll receive a feedback form from today's session. Please do fill that out. It really helps me and the Chamber team to understand what you want to hear more of and how we can support your journey, whether that's here or transitioning back to the UK as well. So please do fill that out. And that leaves me to say a final thank you to Select Investors, to Martin, to Nigel, to you for being with us today. And we look forward to welcoming you at an event with us soon. Have a great rest of the afternoon and look forward to seeing you soon.